A young, wide-eyed adult, fresh out of college, steps into the realm of financial independence. Armed with a first paycheck, he embarks on a spending spree, embracing the thrill of newfound financial freedom. Fast forward a few years, and reality hits harder than a Monday morning alarm. Bills, debts, and financial responsibilities knock on the door, leaving our protagonist wishing for a time machine to revisit their younger self with a critical piece of advice: the magic of financial planning. In this video, I'm going to introduce you to the concept of financial planning and why it's important for young adults to start planning their finances early. I'll also share some of the best practices and tips on how to plan your finances effectively and efficiently. So, stick around. This is the Finance Virtuoso Channel, where we talk about all things finance. For your daily dose of valuable information on money, business, investments, and savings, be sure to hit the subscribe button and click the notification bell right now. Financial planning is the process of setting and achieving your financial goals by managing your income, expenses, savings, investments, and debts. Financial planning helps you to create a realistic budget that suits your lifestyle and needs. Save and invest for your short-term and long-term goals, such as buying a car or retiring comfortably. Protect yourself and your loved ones from financial risks such as emergencies, accidents, illnesses, or death. Lower your tax liability and optimize your cash flow. And improve your financial literacy and confidence. Financial planning is not only for the rich or the old. It is for everyone who wants to take control of their money and their future. In fact, financial planning is especially important for young adults who are just starting their careers, earning their first salaries, and making their first major financial decisions. Here are some of the reasons why you should start financial planning as early as possible. You have more time to grow your wealth. The power of compounding interest means that the earlier you start saving and investing, the more money you will have in the future. For example, if you start saving $100 a month at age 25 with a 6% annual interest rate, you will have $197,392 by age 65. But if you start saving the same amount at age 35, you'll only have $94,902 by age 65. That's a difference of more than $100,000. You have more flexibility and options. When you are young, you have fewer financial obligations and commitments, such as a mortgage, a family, or a debt. This means that you have more disposable income and more freedom to choose how to spend or invest your money. You can also take more risks and experiment with different strategies, as you have more time to recover from any mistakes or losses. You have more opportunities and challenges. The world is changing rapidly, and so are the financial markets and the economy. As a young adult, you have access to more information, technology, and resources than ever before. You also have to face more competition, uncertainty, and volatility than ever before. By planning your finances early, you can take advantage of the opportunities and overcome the challenges that come your way. How to plan your finances effectively and efficiently. Now that you know why financial planning is important for young adults, let's see how you can plan your finances effectively and efficiently. Tip number 1. Pay yourself first. This means that before you spend your money on anything else, you should set aside a portion of your income for your savings and investments. A good rule of thumb is to save at least 10% of your income every month and invest it in a high-yield savings account, a retirement account, or a diversified portfolio. This way, you can build your wealth and secure your future. Tip number 2. Use cash, not credit cards. Credit cards can be convenient and useful, but they can also be dangerous and costly. If you use your credit cards irresponsibly, you can end up paying high interest rates, fees, and penalties, and accumulate a lot of debt. This can hurt your credit score, your cash flow, and your financial goals. Therefore, it is better to pay in cash or use a debit card whenever possible. This way, you can avoid overspending and only spend what you have. Tip number 3. Learn as much as you can. Financial education is essential, but unfortunately, it is not taught in school. Therefore, you have to take every chance to learn about money management, investing, and financial planning. You can read books, watch videos, listen to podcasts, take online courses, or join a community of like-minded people. You can also seek advice from a professional financial planner, a mentor, or a role model. The more you learn, the more you can improve your financial literacy and confidence. Tip number 4. Track your income and expenses. Budgeting is the key to financial planning. It helps you to monitor your income and expenses and allocate your money to your needs, wants, and goals. A popular method of budgeting is the 50-30-20 rule, which states that you should spend 50% of your income on your needs, such as rent, food, and utilities, 30% on your wants, such as entertainment, travel, and hobbies, and 20% on your savings and investments. You can use a spreadsheet, an app, or a tool to create and monitor your budget. Tip number 5. Plan for retirement now. It's never too early to think about retirement. In fact, the sooner you start saving for retirement, the better. Retirement is not only about age, but also about income. You can retire whenever you have enough passive income to cover your living expenses. To achieve this, you need to save and invest consistently and wisely. You can use a retirement account, such as a 401k or an IRA, to save and invest your money in a tax-advantaged way. You can also use a retirement calculator to estimate how much you need to save and invest for retirement. Tip number 6. Invest in your health. Health is wealth. If you don't take care of your health, you may end up spending a lot of money on medical bills or losing your income due to illness or injury. Therefore, you should invest in your health by eating well, exercising regularly, sleeping enough, and avoiding bad habits such as smoking or drinking. You should also buy a good health insurance that covers your medical expenses and protects you from financial risks. Health insurance can also qualify you for a health savings account, which is a tax-advantaged way to save and invest for your healthcare costs. Tip number 7. Keep your money safe. Protecting your money is as important as growing your money. You should guard your money from various threats such as theft, fraud, inflation, taxes, or lawsuits. You can do this by using a secure bank account, a safe deposit box, or a digital wallet to store your money. You can also use various insurance policies to cover your financial risks. You should also have a professional financial planner, a lawyer, or an accountant to help you with your financial planning, legal, and tax issues. Tip number 8. Know how taxes work. Taxes are inevitable, but they can also be reduced or optimized. You should understand how taxes work and how they affect your income, expenses, savings, and investments. You should also know how to file your taxes correctly and on time, and how to claim your deductions and credits. You can use a tax software, a calculator, or a tool to help you with your taxes. You can also consult a tax professional, such as a CPA or an EA, to help you with your tax planning and preparation. So, there you have it. The ABCs of financial planning for young adults. Remember, it's never too early to start, but it can be too late if you wait. If you enjoy this journey into the world of financial wisdom, don't forget to hit the like button, subscribe for more similar content, and let's continue this conversation in the comments below. Until next time, Finance Virtuosos.